Now, the big news overnight, folks, right here, the Japanese 10-year yield surging through 2%. I've talked about this as the likely outcome, predicting that we would see this. And sure enough, yesterday or last night, the Bank of Japan, raised interest rates. They raised interest rates the highest in 30 years. It's still lower than interest rates in the US, but it's continuing to force the 10-year yield in Japan and all the yields to the upside. All right. So again, very crystal clear here. The 10-year yield in Japan is something I'm watching. Now, the reason why the Japanese 10-year is so key, number one, the yen carry trade, which means that, people that have parked money from Japan or borrowed money in Japan to put in the US because interest rates are much, much better. That spread is getting smaller and smaller, right? The 10-year yield in the US is kind of stuck around 4%. Now the 10-year yield in Japan is moving above 2%. As those get closer, it doesn't make sense to park all that money here in the US, and you will see an unwind, which means liquidity gets sucked out of the US markets. The other factor is the bond markets, right? The idea is a rising tide lifts all boats. And so if you have a country with debt to GDP at 240% and yields are just going up, 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 and then you look at the US at 130% debt to GDP, at some point, those yields could start to go up, which obviously would be a catalyst for selling here in the US, even if the Fed is lowering rates. Remember, Fed controls the short end, not the long end. They control short end yields, not 10, 20, 30-year yields. The market controls those. That's really important to understand.
This is what serious traders are watching. If you're looking for mapped levels, macro clarity, and no noise, subscribe and stay ahead of the herd. We're live again weekdays at 9 a.m. sharp. Don't miss it.